Welcome to the modern arena of digital finance. In the world of cryptocurrency futures, the barrier to entry has vanished. With $100 and one single click, any individual can command $10,000 in market power. Exchanges market this as a tool for the small player, a way to build wealth without a massive generational bankroll. It promises the ability to scale a tiny account into a fortune using the right leverage. In traditional accounting, purchasing a stock limits your risk to the capital you deployed. A $100 investment only disappears if the company goes bankrupt and the price hits zero. You are protected by the requirement of a total 100% drawdown. Leverage eliminates that safety net. To wield $10,000 of power, you are borrowing 99% of the position from the exchange. Because the exchange is a business rather than a charity, it will never absorb a loss on your behalf. To protect its own capital, the platform uses an automated liquidation engine to constantly monitor your unrealized losses. The formula the engine uses to calculate when to seize your position looks exactly like this. Your liquidation price is tied to entry, leverage, and the maintenance margin rate. Plug 100x leverage into this equation, and the margin of error collapses. With collateral representing just 1% of the trade, a 1% move against you wipes out your stake. In the cryptocurrency markets, a 1% fluctuation can happen in seconds. A momentary drop in trading volume or a single large market order provides more than enough volatility to cross that threshold. This 1% margin creates an inherently fragile position. The entire system is mathematically engineered to exploit that fragility. This diagram of the order book shows how that exploitation is executed. Thousands of retail traders naturally open long positions around the same price points, leaving their liquidation triggers clustered just beneath a major psychological level, like Bitcoin at $60,000. Institutional players and market makers monitor these clusters. Because the market is a zero-sum game, these large entities hunt for dense pockets of liquidity to fill massive orders without causing excessive slippage. To reach that liquidity, they aggressively sell a large block of assets. This action drives the price down that critical 1%, straight into the retail liquidation cluster. The liquidation engine responds immediately. It seizes the failed retail positions and sells them at market price to instantly recover the borrowed funds. This automated selling pushes the price down even further. The downward momentum triggers the next batch of liquidations, creating a wave of forced selling. This rapid chain reaction, the cascading liquidation wick, can erase millions of dollars in retail collateral in less than a minute. Often, the price snaps back to its original level immediately after the collateral is gone. If you hold a high leverage position during one of these events, your portfolio disappears before your screen even refreshes. An automated sequence just harvested your capital. Beyond the violent flash crash, a quieter mechanism built into the exchange traps traders even when the market is stable. Perpetual futures contracts do not have an expiration date. To keep the futures price tethered to the actual spot price of the asset, exchanges use a funding rate. Every 8 hours, long positions must pay a fee to the short positions if the market is overly weighted toward the upside. This fee's math is devastating. The percentage owed is calculated against your total $10,000 position, but the exchange deducts it entirely from your tiny $100 collateral. When greed causes the funding rate to spike, the fee rapidly consumes your initial margin. A trader could perfectly predict an upward trend and still lose everything. If the asset moves upward too slowly, the recurring fees will drain the account before the trade can become profitable. Eventually, these continuous deductions shrink the collateral past the maintenance margin, forcing the liquidation engine to close the position. The funding rate acts as a ticking clock. It ensures that time alone can mathematically guarantee the destruction of a highly leveraged account. The 100x leverage trap functions as a highly efficient, purpose-built extraction machine. The system relies on the psychological drive for rapid wealth. It uses glowing buttons and the promise of massive buying power to obscure a reality that allows zero margin for error. Sustainable financial growth requires extreme patience, rigorous risk management, and a deep understanding of these underlying mechanics. Every dollar gained in this arena is a dollar transferred from another player. It is a strict zero-sum game. Stepping into this market without mastering the underlying math effectively turns your capital into liquidity for those who do.